In January 2007, Howard Marks wrote a memo to his clients called The Race to the Bottom. Credit markets were euphoric. Lenders were competing to give money to riskier and riskier borrowers on looser and looser terms. Everyone in finance was making money. Almost no one was worried. Marks was worried. His memo, mailed to a few thousand institutional investors that month, said the structure of the credit market had become dangerous, that the gap between what investors were being paid for risk and the risk they were actually taking had collapsed to almost nothing. He didn't predict the timing. He didn't name the crash. He simply said, "This won't end well." 18 months later, the financial system nearly collapsed. The memo became famous. Warren Buffett later said he reads everything Howard Marks writes the moment it arrives, and that the memos are one of the most valuable things in his inbox. The book we're discussing today is Marks's distillation of how he sees the world, and the single idea at its center is the most useful piece of investment thinking anyone has put on paper in the last 50 years. The Most Important Thing was published in 2011. It's a strange book by design. Marks didn't write a textbook. He wrote a kind of investor's commonplace book. 20 short chapters, each titled some variation of "The Most Important Thing is," followed by a different idea. The most important thing is second-level thinking. The most important thing is understanding risk. The most important thing is recognizing cycles. The most important thing is contrarianism, and so on, for nearly 24 chapters. The joke is intentional. There isn't one most important thing. There are roughly 20 of them, and they all have to work together. That's the structural argument of the book before you even read the content. Here's what's strange about Marks's career. He made most of his money buying things other people couldn't sell fast enough. Bankrupt companies, distressed debt, markets that had collapsed. The places everyone was running from. That's where he built Oak Tree Capital, which he co-founded in 1995 and which today manages over $200 billion. His career is the practical application of a single idea. When everyone agrees something is worthless, you should at least check. That idea has a name. Marks introduces it in the first chapter, and the rest of the book is, in some sense, footnotes to it. He calls it second-level thinking. Most investors think on one level. The investors who consistently outperform think on two. That gap, Marks argues, is where almost all the durable returns in markets come from. That's the spine of today's lessons. The first lesson is the concept itself. The next three are what second-level thinking actually does for you, what it protects you from, when to deploy it, and the kind of mind required to sustain it. Lesson 1. Second-level thinking. First-level thinking is what almost everyone does. It says, "This is a good company, so I should buy the stock. The economy is improving, so the market should rise. The earnings report was strong, so the share price should be higher tomorrow." These are reasonable thoughts. They're also worthless, because everyone else has already had them. Second-level thinking is the move past the obvious answer. It asks, "This is a good company, but is it priced as a good company? Is it priced as a great company? Is the price already assuming everything that could go right? Because if the answer is yes, then a good company at a great company price is still a bad investment." Marks's framing is precise here, and will preserve his exact phrasing because the structure matters. First-level thinking says, "It's a good company, let's buy the stock." Second-level thinking says, "It's a good company, but everyone thinks it's a great company, and it's not. So the stock's overrated and overpriced. Let's sell." Notice what just happened. The first-level thinker and the second-level thinker looked at the same company and reached opposite conclusions. Not because they had different facts, because the second-level thinker added one more question. What does everyone else already believe? And what is that belief already priced into? The implication is uncomfortable. To outperform the market consistently, you can't just be right. You have to be right when most people are wrong. If you reach the same conclusion as the consensus, the conclusion is already in the price. You'll earn the market's return, which, by definition, is what everyone earns. The only way to do better is to see something the consensus is missing. There's a corollary worth naming. This kind of thinking only earns a return in places where the consensus might actually be sloppy. The corners of markets, or careers, or industries where most people aren't paying close attention. In the well-followed, heavily analyzed parts of any field, the consensus is usually about right, and trying to outguess it is a losing game. The practical instruction. Stop trying to outperform in the efficient parts of your domain. Identify the inefficient pockets. Spend your second-level thinking there. That sounds like it should be easy. It is the hardest thing in investing. Lesson 2. Risk is what you don't see. This is, in our view, Marx's most important contribution to investment thinking, and it has almost nothing to do with stock picking. Most people define risk by what happened. The portfolio dropped, the investment failed, the deal blew up. Risk, in this view, is visible in outcomes. Marx argues this is exactly backward. Risk isn't what happened. Risk is what could have happened but didn't. His example is sharp. Consider two investors who both made 12% last year. The first achieved it through a portfolio of stable, conservative positions with low downside. The second achieved it by using massive leverage on a single, concentrated bet that happened to work out. Same return. Wildly different risk. But you can't tell the difference by looking at the result. The result is identical. Marx's framing of this is one of the most cited lines in modern investing, and we'll preserve it because the precision matters. Risk means more things can happen than will happen. The world doesn't reveal the alternative paths. You only see the path that actually unfolded. So when a leveraged bet pays off, the investor looks brilliant. When it doesn't, the investor looks reckless. The truth is the same investor in both cases. The only difference is which version of the future arrives. The implication runs deeper than investing. Every decision you make is a bet on a probability distribution you can't see. The outcome you experience is one draw from that distribution. Judging the quality of your decisions by their outcomes alone is one of the most expensive cognitive errors humans make. The decision and the result are different things. A good decision can produce a bad result. A reckless decision can produce a fortune. Marx's discipline was to evaluate decisions by the quality of the reasoning that produced them, not by the outcomes that happened to follow. That habit, separating decision quality from outcome quality, is the single most useful mental tool we've found in his work. Lesson 3. The pendulum always swings. Marx devotes an entire chapter of the most important thing to market cycles, and his metaphor for them is a pendulum. Markets don't move from undervalued to fairly valued and then stop. They swing from undervalued through fairly valued all the way to overvalued, and then back through fairly valued to undervalued again. The middle position, where prices match reality, is the point the pendulum is passing through, not the point it rests at. The reason is psychological. When investors are euphoric, they don't stop buying when prices hit fair value. They keep buying because the prices keep going up, and they can't bear to miss the move. When investors are panicked, they don't stop selling when prices hit fair value. They keep selling because every day brings more losses, and the fear of losing more outweighs the math. This is what Marx's 2007 memo was really about. He wasn't predicting the housing crash. He was observing the pendulum. Credit markets had swung far past fair value into euphoric territory, and historically, every pendulum that has swung that far has swung back. The question wasn't whether. The question was when. The practical move for the non-investor. Pendulums don't only swing in financial markets. They swing in your industry, They swing in your career. They swing in the public mood about any technology, any geography, any asset class. When you notice consensus has moved to an extreme, when everyone in your field agrees on something, that's almost never the moment to agree with them. That's the moment to start looking for what the consensus is missing. Lesson 4. Know what you don't know. Marx divides investors into two schools. The I know school believes the future is knowable, that with enough analysis, you can forecast where the economy is going, what interest rates will do, which sectors will outperform. The I don't know school believes the opposite, that the future is fundamentally uncertain, that forecasts are mostly noise, and that the right move is to prepare for a range of possibilities rather than predict the one that will arrive. Marx belongs firmly in the second school. He has written repeatedly that the most dangerous people in finance are the ones who think they know what's going to happen, and that the most useful people are the ones who admit they don't and who structure their decisions accordingly. One of his most famous memos is titled, "You can't predict, you can prepare." The distinction matters because it changes everything about how you behave. An I know investor builds a portfolio optimized for the future they believe is coming. An I don't know investor builds a portfolio that can survive whichever future actually arrives. The first approach maximizes upside if you're right. The second approach minimizes catastrophe if you're wrong. Over a long enough timeline, the second approach wins, because everyone is eventually wrong about something important. This is the deepest lesson in the book, and it's the one that's hardest to internalize. The financial press, the investment industry, the entire ecosystem around markets is built on the premise that someone knows what's coming. Marx's contribution is the quiet, persistent reminder that nobody does, and that the investors who admit this clearly outperform the ones who pretend otherwise, because they're the only ones who size their bets accordingly. The Most Important Thing is one of the best investment books ever written, but it has real limits. 3 honest critiques worth naming. First, the book is heavy on principle and light on mechanics. Marx tells you to think on the second level. He doesn't tell you how. The instruction to ask, "What does the consensus already believe?" is correct, but it isn't a process, it's a posture. Readers who finish the book often feel intellectually equipped, but operationally unsure. The frameworks are right. The drills for building the habit aren't there. Second, Marx's career is in a specific kind of investing, distressed credit, where the inefficiencies are unusually large and the second-level edge is unusually durable. The thinking generalizes, but the returns don't. A reader who takes Marx's principles and applies them to large-cap public equities will not generate Oaktree's results, because that market is far more efficient, and the same discipline produces a much smaller edge. The book occasionally implies the thinking is sufficient. The thinking is necessary. It isn't sufficient. Domain selection matters at least as much. Third, and this is where we'll get slightly opinionated, the book treats contrarianism almost as a virtue. It isn't. Contrarianism is a tool. Being wrong with the crowd and being wrong against the crowd are equally costly, and the second often feels worse because you have no company in the loss. Marx's contrarianism worked because he combined it with deep analysis and rigorous risk management. The contrarianism without the analysis is just contrarianism, and it loses money more reliably than going along with the consensus. The lesson isn't to disagree with the crowd. The lesson is to disagree when, and only when, your analysis genuinely supports a different view. What survives untouched is the core framework. Second-level thinking, the asymmetry of risk, the pendulum of cycles, the discipline of admitted uncertainty. These are durable tools. They work in any market, any decision domain, any era. They don't guarantee Marx's returns, they guarantee something more useful. a substantial reduction in the kind of confident, consensus-driven mistakes that ruin most investors. So here's the one thing to do today. Not tomorrow. Today. Start a consensus log. One sheet of paper. Across the top, write the date. Down the left, leave room for 10 entries. The next 10 significant decisions you face, financial, professional, strategic. Before you make each one, write one sentence on the log. Not your view, the consensus view. What does everyone informed in your field believe about this situation right now? That's the entry, one sentence. Then, make the decision however you would have made it anyway. You don't have to be contrarian. You don't have to identify what the consensus is missing. You don't have to disagree. The exercise is simply to name the consensus before you act, so it's visible to you. 6 months later, reread the page. You will discover two things. First, how often the consensus turned out to be wrong, almost certainly more than you would have guessed. Second, how often you went along with it anyway, also more than you would have guessed. That gap between what you wrote down and what actually happened is the most valuable diagnostic any thinking person can run on themselves. You're not trying to beat Marx at distressed credit. You're trying to install a habit he spent 30 years building. The reflex to see the consensus clearly before you act on it or against it. Once that reflex exists, second-level thinking becomes possible. Without it, every decision you make is first level by default. 1 page, 10 entries. 6 months. That's the assignment. Howard Marks has been writing his memos to Oaktree clients since 1990. 35 years of disciplined, careful, second-level thinking written down in real time in front of an audience of the most sophisticated investors in the world. The memos are still being written. They're freely available on Oaktree's website. They are, in our considered view, one of the most valuable libraries of investment thinking ever assembled in public. But the lesson worth taking from Marx isn't a forecast, or a stock pick, or a market call. It's a habit. The habit of asking, before every decision, what the crowd already believes, and whether you have any genuine reason to believe something different. That habit, applied for 30 years, is what built Oaktree. Applied for the next 30 years of your career, it's what compounds into the kind of judgment that's almost impossible to replicate. One question worth sitting with, and we'd genuinely like to hear your answer in the comments. Think of the last major decision you made. What did the consensus believe about it at the time? And, honestly, were you running a first-level view, or had you actually identified what the consensus was missing? Not the comfortable answer, the accurate one. Subscribe. We break down one great book every week. The foundational ones on money, business, and decision-making. The lessons that compound. Until then, think twice. Decide once.